Gold's come off quite a bit. It was at 4,400. It's below 4,000 now. It's 3,966. It could easily retrace to the 3,500 level. Similar considerations apply to silver, though it's much more driven by the private investor than large institutions, which aren't really putting silver into their portfolios.
September, October, gold just moved too far, too fast. And you were beginning to see some sort of indications that we were going to have a temporary top. But personally, I just don't think it's anything to be overly concerned about. Of course, when you look at your statement and it's down 15% from what it was, a month ago, that is of concern. And I think that's going to be the big story for the next 6 months. Now, the big question mark or spanner in the works, of course, is that Powell is going to step down. So we'll have a bit of a new board, new composition, etc. But I think that's going to be the next big move. And that is just wildly bullish for gold, wildly bullish.
Gold's recent pullback has caught the attention of investors worldwide. After surging to around $4,400, the metal has slipped below $4,000, settling near $3,966, a standard and even healthy retracement after a steep climb. Markets rarely move in straight lines, and this correction could extend to the $3,500 level without breaking the broader uptrend. Silver, too, has mirrored gold's behavior, but remains more influenced by private investors rather than institutions, which still treat it as a speculative play rather than a core portfolio asset. Despite the volatility, the structural fundamentals remain firmly intact. Adrianday, a global asset strategist, and Clive Thompson, a veteran market analyst, emphasize that the recent dip is not a cause for panic, but rather a natural phase in an ongoing bull market cycle. They note that gold's surge in September and October was too fast to sustain, inviting short-term profit-taking. Yet the macro backdrop, leadership changes at the Federal Reserve, shifting global monetary policy, and ongoing currency debasement, points to a much larger, long-term bullish setup. When policy pivots, gold historically accelerates, and this time appears no different. Now we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold just ran up far too far, far too fast, particularly, since August. Frankly, even if you look back at the last 2 years, it's been an extraordinary run for gold, but particularly in August and September, October, gold just moved too far, too fast. And you were beginning to see some sort of indications that we were going to have a temporary top. But personally, I just don't think it's anything to be overly concerned about. Of course, when you look at your statement and it's down 15% from what it was, a month ago, that is of concern. I don't think it's going to be a very I don't think it's going to be a very deep correction, but it's clearly, not clearly, but it's probably going to last, it could easily last a couple of months. But I say all that because, first of all, you have to look, is this a top? That's the fundamental question, have we seen the top? And I think we are so far from a top, and there is just no evidence. When you're at a top, you get huge public participation. You get a manic feel. So you hear about gold at dinner parties. You hear about gold on CNBC every night. There's massive inflows into the gold funds. We haven't seen any of that. So I think we're so far from a top. And, compare it with 2011 or 1980, where you could see massive inflows coming in at the top. We're not there yet at all. Just don't let this correction spook you. It's perfectly normal in the middle of a bull market to have a significant correction. This really isn't even a correction yet. Let's not forget that. This is just a pullback. But we haven't had a correction in this bull market since gold bottomed if you go back just to 3 years, we haven't had a correction. And it's perfectly normal to get corrections. So you think back to 2006, where the price of gold dropped about 30% in a week. Does anyone remember that? Nobody remembers that anymore. It's just a blip on the chart. Now, when you were living through it, it was awful. But it's just meaningless at this point. So these sort of things are normal. And so what you really have to decide, I'm sorry, this was a closing thought, wasn't it?
Keep going.
The thing you really have to decide is, do I think this is the top, like 2011, like 1980, and we're going to go into the wilderness for another 10 or 15 years, or is it just a correction? If it's just a correction, you absolutely do not panic and do not even think of selling stuff after they've already dropped like this. And on the other side, I mean, if you really honestly think this is a top, I feel sorry for you, but there's no, seriously, what is the evidence for thinking this is a top other than the fact that I remember 2011 and I don't want to live through it again? Well, that's, if I may, and that's what I hear from so many people, but if I may, that is not, rational analysis. That's just emotion. So if you analyze the market, what are the reasons to say this is the top? And in my view, there are no reasons whatsoever. The fundamentals are still positive for gold. The people who have been buying gold are still buying it for the same reasons. The reasons haven't gone away. The valuations of the gold stocks are still very, very cheap. And lastly, and this will be my last, if you look at a log graph, right, okay, so for the last 2 months, we said, oh my gosh, look at gold. It goes up $100 every day. Oh my gosh, another new high. Oh my gosh, another new high. Look at it on a log graph. It is, I won't say insignificant, but it is a small rally relative to 2010-11 and 1979-1980. So relative to the previous blow-off tops, this is a meaningless rally. We only look at it in a log graph. That's what we should always do, because that tells us what the percentage gains are, which is what's important. So yeah, bottom line, I don't think this is a top. I don't think this is anywhere near a top. I think the Western investor typically will move into gold when the economic environment, when the economic factors favor gold. The North American investor, unlike central banks, unlike Chinese investors, Asian investors, Middle East investors, and even European investors, we have no real experience of gold being really valuable as an asset of last resort. In Germany, they still think about the Weimar Republic and the runaway inflation. Nobody alive today lived through it, but they still think about it. Their grandparents told them about it. Same with Italy, same with France. And of course, Hong Kong, people who fled from China carrying their gold to enable them to start life again. We just don't have that kind of experience in the U.S. And so in the U.S., people typically, they say they buy some gold for insurance, right? But it's just not in the DNA. Typically, people in the U.S. buy gold as an investment when the economic environment is right. And what that means is a weakening economy, low and declining interest rates, high and rising inflation, and a weak dollar. And until recently, the narrative, if not the reality, has been completely the opposite of that. And so if you think back a year with a strong economy and a strong labor market, solid, Jerome Powell told us, inflation coming down dramatically, and the dollar reasonably strong, that was not conducive to buying gold. So I think what the trigger might be next time is one of two things. Either the stock market rolling over so people with profits in NVIDIA and Microsoft start to look for somewhere else to put their money, or it could be a pickup in inflation, because people think of gold as an inflation hedge. You ask 100 people in the street, they'll say, oh, well, gold is a good inflation hedge. We can debate that, but that's what will make people buy gold, I think. I mean, honestly, I think if Powell remained chairman for the next 12 months, which isn't going to happen, I think we would get there anyway, because he's reluctant to cut rates, both because he doesn't want to make it seem like he's just doing what Trump tells him to do, and that's just a natural human reaction, but equally because he doesn't want to cut rates too fast, too much too fast, and get inflation out of control. And so, as it were, splitting your monetary easing between reducing interest rates and buying treasuries is a way to lift a little bit of a pressure in the near term off inflation. So I think we would see that anyway, but certainly Mirren, and if Trump appoints more people like him, they will have no compunction about just printing money to buy treasuries. Besson said he has a list of 5 people. He's doing final interviews, and then he'll narrow that down and present the list to Trump. Yeah, I don't have any particular... I'm not betting on who it is. All I will bet on is it will be someone who wants to ease monetary policy. To me, there were 2 big takeaways from that. The first one was it's clearly a divided Fed. And of course, the fact that 3 Fed members came out the following day and said that they didn't want a December hike just reinforced the fact that it's a divided Fed. And so Powell, that's why he pushed back so much on a December cut, because it's not a done deal at the moment. So that was one big message, that the December cut is not, not a foregone conclusion. I frankly thought we would get a December one, and I thought the October one was a question mark. But anyway, we'll see. I mean, personally, I think the odds still favor that we will get a cut, but at least it's not a foregone conclusion. But the second thing that I think was a really big takeaway from that meeting, apart from the fact that he looked a lot more tired than he has in months past, the other big takeaway was the end of QT. And, QT, we talked about this last time, I'm pretty sure. QT is effectively ended anyway. When they cut it in March or April, they cut it down to $5 billion a month. $5 billion a month of roll-off on a $6.5 trillion balance sheet is little more than a rounding error. So effectively, they had already finished it. But he actually announced as of December 1, there will be no more QT. Okay. He also said that any money that rolls over from mortgage-backed securities that matures will be put back into treasuries. Excuse me. Well, that begins to sound an awful lot like QE to me. The beginnings of QE. And I suspect that that's going to be the next. We talked about this before. I was a bit of an outlier. I was certainly a little early on that because I thought we'd be seeing it in the fall. I think the government shutdown kind of delayed the timing on that, because if the government shut down, you don't need so much money. Although, as a tangent, it's really ironic. The government shut down, but they still seem to be spending 99% of what they spent before. But anyway, ending QT for sure, and putting money that matures in mortgage securities into treasuries really sounds like me to the beginning of QE. And I think that's going to be the big story for the next 6 months. Now, the big question mark or spanner in the works, of course, is that Powell is going to step down. So we'll have a bit of a new board, new composition, etc. But I think that's going to be the next big move. And that is just wildly bullish for gold. Wildly bullish.
Gold's recent correction is a textbook example of market digestion after an exceptional rally. Following its surge to $4,400, the metal has slipped below $4,000, with potential for a brief sideways phase or even a modest retracement toward $3,500. This is not a signal of weakness. It's the market catching its breath after moving too far, too fast. Despite the short-term softness, the broader trend remains firmly intact. Institutional and retail investors alike are beginning to recognize that this pullback may be laying the foundation for the next leg higher. With the Federal Reserve signaling the end of quantitative tightening and inching closer toward a renewed easing cycle, liquidity is set to return in abundance. That shift has historically been one of the strongest catalysts for gold. The mechanics of institutional portfolio rebalancing are also setting the stage, as risk managers and asset allocators begin factoring gold into long-term models. Demand is poised to grow structurally. Corrections are not endings, they're the pauses before momentum resumes. Gold remains in a powerful uptrend, supported by weakening monetary discipline and growing global uncertainty. Let's get back to the interview.
Gold's come off quite a bit. It was at 4,400. It's below 4,000 now. It's 3,966. It could easily retrace to the 3,500 level. I think that we go down, or I don't say we get down. We don't know if we're going to go down. I think we probably go sideways for a while. My best guess is another month and a half of that, 2 months nearly. I think we go sideways for a while as we go into the run-up to Christmas. But next year, a lot of investment firms will be wanting to put gold in their asset allocation because the maths will prove that if you have some gold in your asset allocation last year and last few years actually, it would have improved returns and it would have reduced volatility. Now, it takes a long time in most large companies to change your asset allocation table because you've got a lot of things to do before you can it's not just one guy sitting at the top of the pile saying, oh, let's add gold. You've got to go through a lot of different departments. You've got to go through the legal department, the compliance department, the risk department, the custody department. I mean, just as an example, if you decide to add gold to your asset allocation, the custody department has got to, well, let's start with the investment management department's got to decide how are you going to put gold in the portfolio. Will it be gold mining shares? Will it be physical gold? Will it be gold in an account? Will it be a gold exchange traded fund? Will it be some sort of customized instrument? They've got to decide how, and then the legal department's got to take a look at it and say, is this legal? Is this allowed by the investment management rules of our country? And then you've got the compliance department looking at it. And then you've got the safe custody department saying, well, if we decide to buy an exchange traded fund, who are we going to custody it with? How are we going to do it? Is it safe? Have we got the right agreements in place? If it's gold, physical gold bars, again, another problem. How do we do it? Where do we store it? So there's a whole raft of departments get involved if you change the asset allocation. That's why firms which are thinking about doing it will still take some time, but the target for most of them will be to get this gold probably as part of their asset allocation for next year, and they'll be announcing that asset allocation towards the end of the year. So I think gold will drift sideways to the end of the year, and then as we go into Christmas, it will start to anticipate the buying from investment managers next year, and then we'll start to see a recovery. Probably, in my opinion, and this is not investment advice, but in my opinion, I think it's quite likely we'll break the all-time high of 4,400 and something, and probably move higher throughout the year. Just my guess. Similar considerations apply to silver, though it's much more driven by the private investor than large institutions which aren't really putting silver into their portfolios. But the other side of the silver drive is coming from industrial use, where we know the industrial use exceeds the mine supply. And of course, we've got electronic use increasing a lot. What we're looking at there is a silver miners exchange traded fund, and we look at the gold miners exchange traded fund as well. Both of these are off a lot this year. Or not this year, but they're up a lot this year. But for example, take the gold miners VanEck gold miners ETF known as GDX. It's come off from a high of about $85 to $69. So big decline since the peak. And that's because the gold price has come off from the peak, and people are saying, well, my God, it's going back to 2000. I don't think that's the case, but certainly lower is likely, and that does mean that the short-term traders jump in and out of these gold mining stocks very, very fast. My strategy on gold mining stocks is just hang on to them. I think it's my personal view, many of the stocks I've looked at are not reflecting a gold price of $4,000, for example. They're reflecting something in the range of $2,500 to $3,500, typically $3,200, something like that. So they're not the price of the shares is reflecting a reality of 6 months or a year ago, not of today's gold price. Now, of course, you can take a view, well, today's gold price is going down, or you can take a view it's going up. But if gold price stays where it is, a lot of these gold mining companies are rather undervalued compared with where they should be next year, assuming the gold price stays where it is, and they can mine all this gold and sell it at a higher price than they sold it for last year. I've done the maths on quite a few companies. One or two are trading slightly below fair value, which means that I wouldn't buy them. But the vast majority, in my opinion, are and remain undervalued. Yeah, the dollar index. Here's the dollar index. It started rising. You see it's come down from the end of the year by about 12% or 11%, 9% actually now. But it's just climbed back from a low point of about 96-ish to just over 100-ish. So dollar index is a basket of currencies measured against the dollar, and it seems the dollar's doing quite well. Why is it doing quite well? Well, the consensus was that we were going to get two interest rate cuts before the end of the year. One in November, which we just had, in fact. Actually, it was in October, late October, and one in December. The view is now that the December cut is less than sure. Jerome Powell, at his latest conference, said, whilst he was cutting by 0.25%, he said, it is less than certain we'll see another cut, or something to that effect. So that means that interest rates might not fall, which means that people are now buying they're less keen to buy interest rates might not fall, so they're more keen to buy the dollar or hang on to their dollars, or rather less keen to sell dollars for other currencies, because often when an interest rate is reduced, it's expected that the currency will fall. Let's go to China. President Trump has announced a trade deal with China. So they're going to suspend these 100% tariffs on China starting from November the 10th. And China has announced that it will allow the export of rare earths after all, for the benefit of US end users. So it doesn't say for sure that it's going to be allowed for defense purposes, but it doesn't say it won't be. So I guess they basically got rid of the restrictions completely. However, Trump has said that the most advanced intelligence chips, the artificial intelligence from companies like NVIDIA, will remain restricted for export to China. He says that the cutting-edge AI technology will be reserved for US companies and allied nations. Another part of the agreement is that Taiwan, or China, has said that they will not invade Taiwan while President Trump remains in power. I think maybe that's a bit of a worrying statement. Does that mean they will invade Taiwan when he's out of power? And can you trust the words at all anyway? That's the other question. But anyway, that seems to be some sort of vague deal which has been done. Anyway, if promising not to invade your neighbouring country, and maybe I'm calling it wrong, because of course Taiwan is theoretically part of China, but threatening not to invade Taiwan is, if that's good, well, that's excellent for them. Interest rates, we know that the Federal Reserve cut the interest rates last week by 0.25% to 3.75 to 4, but they've basically also said that they will Jerome Powell has said that a cut in December is not a foregone conclusion. And he's also announced that from the 1st of December, I think it is, they're going to stop the quantitative tightening program, which basically opens the door for quantitative easing, which is an expansion of the Federal Reserve's balance sheet when they print money to buy government bonds. We'll see if that happens. It's not decided to do that. They're just saying that could be the next step.
Every cycle in gold follows a rhythm: surge, pause, consolidate, and then climb again. What we're seeing now is the natural resting phase of a long and powerful bull market. Markets are recalibrating, profit takers are stepping aside, and stronger hands are quietly building positions. Each dip strengthens the base for the next move, as confidence shifts from speculation to conviction. The fundamentals haven't changed. In fact, they've only deepened with global monetary uncertainty and the quiet return of quantitative easing across major economies. These are the conditions where long-term value is forged. Gold remains the anchor of financial truth, the asset that outlasts every policy pivot and every fiat experiment. Those who understand this cycle know that patience is as valuable as timing. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video.